Interest rates on mortgages are going up. But why? In this video, we'll take a look. Interest rates. Let's start with where they come from. Or actually, let's start with where they don't come from. You might hear someone say, the Fed is raising rates, but that is not the federal government raising the interest rates for home mortgages. They don't have that power. Well, not directly anyway. The Federal Reserve, the central bank of the United States, is charged with regulating all the banks in the U.S., managing inflation, stabilizing financial markets, and many other things. But let's focus on its role in managing inflation. Inflation is a general increase in prices and a fall in the purchasing value of money. So inflation is pretty normal, but it's better if it's not too high. One way the Fed fights runaway inflation is by affecting the price of money. So let's talk about the cost of money. And let's use Monopoly as an example. And I realize that it isn't a perfect analogy, but go with me on this. Each time you go around the board and pass go, you collect $200. The trip around the board is the price of money. So if you needed $1,000, it would cost you 5 times around the board. You use that money to buy properties or pay rent or whatever spaces you land on as you continue around the board. And if you have no other sources of income, that $200 from pass and go really influences what you can and can't buy. So if you land on Park Place, you're probably not going to be buying it. Now, imagine when you pass go, instead of getting $200, you get $1,000. The cost of money has gone down significantly. Now you're not only in the market to buy Park Place, if there were multiple people interested, you could afford to pay above the asking price. You have more money because the price of money went down, and now you have more buying power. But you're not the only one with more buying power. Everyone now gets $1,000 when they go around the board. Suddenly, every player is sitting on a pile of cash. And when everyone can afford to overpay, prices rise to match the players' budgets. Let's say you have Marvin Gardens and Denver, but you need to get Atlantic to complete the set, and your opponent has Atlantic Avenue. It originally only cost them $260, but now, with you sitting on a big pile of cash, you're going to be paying a lot more than that if you want to buy it. Because if you don't overpay, the person sitting next to you can certainly afford it. The increase in cash on the board has caused prices to go up, to inflate. And the cash increases happens because cash got a lot cheaper, less trips around the board. If there were such a thing as a game czar and you were it, and you were worried that the prices were getting out of hand, one way to control that would be to make money less available, more expensive, by lowering the amount you get for each trip around the board. Okay, the game of Monopoly has always taken way too long, and this analogy is starting to get a bit long. So let's get back to the interest rates on your house. For us, in the real world, the price of money can be thought of as the interest rate, since interest is the money we pay for the privilege of borrowing money. If inflation is high or is on the rise, one way to slow it down and keep prices from getting out of hand would be to raise the interest rates. Higher interest rates mean you pay more to borrow the same amount of money. That makes money less available. If money is less available, everyone buys less. People buy fewer cars or vacations, houses, or they buy cheaper versions, or they put off their purchases. When people buy less, that tends to stop prices from going up. So, how does the Fed accomplish keeping inflation down if they don't have access to the tools of directly raising interest rates? Banks. In their regular course of business, banks need to borrow money, and they can either do it from each other or from the Fed. Whatever interest rate the Fed charges, banks charge each other less, ensuring that they get the business of that loan instead of it going to the Fed. But this also allows the Fed to influence the rates that banks charge each other. If they raise their rate, banks do as well. And when banks pay higher interest rates to each other, they pass those higher rates on to the customers, whether it's car loans, personal loans, or your mortgage. We're currently seeing inflation unlike anything we've seen in the last 30 years. To counter that inflation, interest rates are on the rise. The average rate, according to Freddie Mac, on a 30-year fixed mortgage is the highest it's been since 2018. So interest rates are high, right? Well, it depends on your perspective. From July 2013 to June 2019, rates were generally between 3.5 and 4.5. That would put today's rates in the normal category. But if we look back further, our current upward trend is only a tiny bump. Millennials getting mortgages today, myself included, have nothing on their rates that their parents were paying back in the early 80s when rates at one point topped 18%. So, where do we see rates going from here? No one can know for sure. There's just too many factors. But it seems likely that given inflation, we will see rates continue to rise in the near future. If you need help navigating our current market, send me an email. I'd be happy to help. Stay safe and thanks for watching.